Hello, everyone. My name is Shubham, and I'd like to welcome you all to another edition of KiwiTech's Venture Capital Panel. Today, we have a fantastic panel discussion on unearthing insights and lessons from investment experiences, followed by a 5 high-value growth stage startup presentations. Now, let's get started with a brief introduction to KiwiTech, followed by the Venture Capital Panel. It's my pleasure to introduce KiwiTech, a one-of-a-kind innovation ecosystem that's home to 500 plus portfolio startups and 300 plus mentors, all committed to supporting innovators globally. It all began in 2009 when a team of seasoned entrepreneurs who had previously built and scaled a publishing services company for a 9-digit exit decided to start another company to empower startups with innovation. All in all, we at KiwiTech particularly team up with early to late startups to support entrepreneurs with a 360-degree support in terms of technology, fundraising, mentorship, networking opportunities, and go to market strategy. Now, without further ado, I would like to invite our panel moderator, Ike Saeed, SVP of Strategic Partnerships here at KiwiTech, to start with the panel discussion. Hi, Ike. Good afternoon. How are you?
Wonderful, Shubham. How about yourself?
I'm doing great too. Thank you so much for asking. Now you have the screen to yourself.
Fantastic. And just to, you can see me and hear me clearly, yes?
Yes, I can.
Perfect. Well, good afternoon, good morning, folks. Good evening, depending on which part of the world you are calling in from. As Shubham mentioned, my name is Ike. I'm the SVP of Strategic Partnerships based in the Washington, D.C. area. Super excited to moderate this venture capital panel discussion from 3 experienced investors, executives from across North America. I'll say their names one by one. Would love to have them switch their video on and join the discussion. First, we have Karan joining us from Boston, part of Elevate Finance. Second, we have Suzanne Reed from Chicago Portland Ventures joining us from Chicago. And third, we have Mayuran based in Toronto joining us, working in the venture capital arm of Index Exchange. And we have everybody here. Perfect. In the same order, would love to have the 3 of you describe your fund, your investment theses, let our audience know a little bit more about the organization that you're a part of. And again, in the same order, I'll start with Karan. Do you want to kick us off?
Yes, great. Thank you, Ike. Can you all hear me well?
Yes, we can hear you.
Okay, great. Yeah, so once again, I'm Karan Bhatia. I run a platform called Elevate Finance. We are a venture lending fund. What that basically means is we provide debt capital to early stage companies all the way from seed to Series A, Series B, and upwards, anywhere from 500,000 to up to $10 million. Yeah, we're headquartered here in Boston, but have a strong arm in Singapore and as well. So we lend across the US and Southeast Asia and India. Thanks.
Welcome. Suzanne?
Thank you, Ike. Well, thank you very much for inviting me. I've participated in some of the seminars you've held in the past, and really appreciate the quality of the companies you bring. In fact, actually, the angel group I run, Chicago Archangels, invested in one of them. And we look forward to hearing more about the companies presenting today. So I am actually involved in 2 things. I founded the Chicago Archangels, which is a very active angel group here in Chicago. We actually invest in companies from all over the country, and we're industry agnostic. We're pretty much interested in seed and Series A companies. And then the other thing that I do is I worked with a couple of other people to form a cross-border fund with Poland, and we just completed 12 investments. So those investments went into some Polish companies as well as some companies from the United States that want to launch into Europe. So the next step would be hopefully to build a second fund or an accelerator, and we'll keep you posted.
Fantastic. Congratulations.
Thank you.
And last but not least, Mayuran.
Hey, Ike, thank you for the intro. Great to be here, everyone. Thank you for having me. I'm from IX Labs, the venture arm of Index Exchange. I'm part of the founding team at Index Exchange. We've been around for 20 plus years. I was the head of engineering until we launched the venture arm. I now run the venture arm. The venture arm invests in early stage startups, so typically pre-seed and seed. We do not have a fund. This is a corporate venture arm, and we invest off the balance sheet. So we invest in early stage startups in a number of verticals, including fintech, hardware, so things like sensors, IoT, drones, robots, as well as clean tech and agriculture. Thank you.
Fantastic, wonderful. Really loving the diversity here. Obviously, folks coming in from corporate venture capital backgrounds, venture financing, angel groups, cross-border transactions. So this, I think, will be a fascinating discussion. So for our audience, I like to keep it super interactive as we go along. Any links, any interesting tidbits that I find, I'll post them on the chat window, so keep an eye on that. And then same request for our panelists, feel free to share your thoughts, experiences. Again, our audience is really here to learn from your experience, and so would really appreciate that. All right, so my phone buzzed about 5 minutes ago, and I think, as probably most of the audience, that the Fed decided not to hike the interest rate, citing cooling inflation, as well as the unemployment numbers. So kind of, I imagine those of us on the investment side are heaving a sign of relief. 1 second. But having said that, coming into this year and even into this quarter, the numbers have been quite abysmal. And again, I'm just going to read the latest reports here. That up until 6 months of this year, so H1, cumulative Q1 and Q2, there were 4,218 deals that were disclosed with a total value of $64.6 billion. This was a 35% decline year over year for deal volume and 49% in terms of deal value. So today's announcement notwithstanding, this is how I would like to start out. And maybe we'll go in reverse order this time, starting from Mayuran, and then going on to the rest of the panelists. How do you see Q3 finishing up? Obviously, that's going to be next week, and then Q4, and then the entire 2023, and going into 2024. Do you think, again, we will be seeing a reversal for these trends that I just mentioned, investments kicking up? Or do you think, again, you as investors will continue to be cautious, kind of wait and see how the markets are, maybe waiting for better valuations? So again, Mayuran, would love to start from you, and then in the meantime, I'll post that link in the chat window. Go ahead, Mayuran.
Well, it's great that they were able to maintain the rate and not do another hike. To answer your question, I think investors will largely be adopting a wait and see approach. At least that's my read. That's certainly what we'll be doing. On top of the deal values, the deal count, and the amount raised, the other thing we didn't really touch on was valuations, right? Like valuations year over year were down 15%. And coincidentally, 15% of the rounds are also down rounds, right? So there's a lot of companies that are raising that are running into issues, and if they're not able to raise at a favorable valuation, they're forced to do a flat round, or even worse, a down round. So I think for us, my read is that investors will continue to be cautiously optimistic, I would say. There is some positive news. I would say, there's a lot of dry powder that's waiting. I think it's something to the tune of 300 billion, something like that. I think there's a little bit of a wait and see to see how best to deploy that capital that's been building up. The other thing I would want to highlight is this week was pretty big for IPOs, right? We've got Instacart IPO'd at a pretty decent, pretty reasonable, pretty respectful amount. It's been holding up. ARM had a great IPO, and from what I read, Instacart was able to reprice based on how well the ARM IPO went. And I believe Klaviyo has an IPO coming up again also this month. So it's a pretty hot month for IPOs, and I think it does seem like there's a little bit of the IPO market is a little bit warm now, which is great. This will create liquidity, which could have all sorts of a halo effect on everything else that we're seeing. So long as inflation is continuing to cool and the rates remain lower or held, as long as they're not being increased, I think there's some optimism to look forward to. But overall, I do think most investors will likely approach with with some caution, wait and see attitude.
Awesome. Suzanne, agree, disagree?
Yeah, I agree. Actually, in running an angel group, it's a little different from a venture fund because our members are writing checks out of their own pocket. So it's very much whether they feel motivated to invest and how they see things going. And I would say things definitely slowed down at the Q4 of last year and the first quarter of this year. In fact, there were no investments from our group, and I was a little worried because we usually are more active than that. But then starting around April or May, things started to pick up and we're back at normal. I would say there are probably people who, or I know of people who are just not investing right now because they can earn good money off of the interest rates with no risk, right? So there's always going to be that movement of capital to where people can think they can do the best. And I think the other thing I would say, if you're a company that's looking for capital, don't let any of this really scare you. We still see companies closing their rounds. Maybe they have to knock on more doors, have more conversations, but it can be done. I would say always look for the right partners and also just make sure you have a good story to tell.
Sure, absolutely. And then finally, we have Karan.
Yes, yeah, I would, look, largely agree with what Mayur and Suzanne said with the slight caveat, right? We're coming off, probably one of the most biggest bull cycle in VC and early stage investing that we've seen, probably ever. So while, I'd agree that there's still a lot of liquidity on the sidelines, and especially, yes, with, some of the economic measures coming back and interest rates cooling off, we should see interest in these investments come back. I think it's going to be a while before it goes back to those days, right? But again, to the points that Mayuran and Suzanne made, good teams, good companies, good ideas that are well managed and prudently run will continue to get funded. It may take longer. Valuations may not be, some of the crazy valuations we've seen, but there's still capital available for good ideas and good teams.
Wonderful.
And that will continue to grow.
Perfect. And Karan, maybe let's stay with you. When you're looking at your investment decisions, specifically at Elevate Finance, obviously a little bit different than traditional venture capital investment. What are some of the risk factors that you look at when being, how much to put in, when to kind of, put in a certain amount, geography, industry, can you share a little bit more with us?
Yeah, and yeah, look, to your point, we look at these investments a little differently than traditional VCs or at least other early stage investors, right? We have to be a lot more careful about our downside, right? Because our upside is limited, right? So we assess risk very carefully, and for us, one of the big factors we look at is, what is the exit, right? And, for us, exits getting delayed or elongated have a much larger impact than that might be for, a VC or other investors, right? So that is one of the key risk factors we're always looking for. And then that ties into a lot of other things, right? Like, what is the trajectory of cash flows? What is the timing of this investments? It could be great. It could be a great company, great business, but it may not be the right time for them to take on our kind of investment, right? Might not be the right time for them to take on a venture loan. So that is something we need to assess very critically. So I would say yes, timing and timing of both entry and exit become very critical for us, right? More than assessing the business.
Got it. And Suzanne, so over here in DC, I'm quite closely involved with the MIT Alumni Angel Club of the DC area. So obviously, angels, we think about this very differently when we say risk, right? Would love to, hear more at, the Chicago Poland Ventures, kind of how are your individual members, because obviously, they're writing individual checks, how are they looking at risk? Does everybody come to a consensus? Does everybody make up their own mind and, kind of free to go in and write as big of a check as they want? How do you guys look at risk and evaluate companies?
Sure. Like if we had to do consensus, we would never invest. So I've seen angel groups come and go because they try to reach consensus and it can't be done, right? So we actually function at the Chicago Archangels more technically as an angel network. So people are writing their own individual checks. We don't aggregate them together. And that means that the members will collaborate with each other and share insights and comments, and due diligence can be done together. But at the end of the day, they make up their own mind. So when I am talking to a prospective member, I say, if you join our group, you have to have the courage of your own convictions because you may sometimes be the only investor in that company. And usually at that point, people turn a little white in the face and look scared. But I think it is a very friendly and collaborative group. And then for the fund, obviously that's different because we had a whole team and we had people in Poland who were doing the research and coming up with their assessment. And I would say the one thing I wish we had done, we didn't know about this when we started, but I think with the fund, no matter what size you are, it's a good idea to do a deal memo on why you invested and look back at that periodically to see if you're on track and what lessons can you learn from that decision you made and how you made that decision.
Got it. And then Marian, with a corporate venture capital fund, again, different than a traditional 10-year close-ended fund, so would love to learn more about how you evaluate risk. So for example, for your portfolio companies, does there has to be an element of strategic benefits that are being provided back to the mothership, given that obviously that you're investing off the balance sheet? Is it completely independent from the mothership, so to speak? Would love to learn more about kind of how you look at risk and in the companies you look at.
For sure. So the parent company is a programmatic ad exchange. So we're in the online advertising space. That's the company, the broader company that has 550 plus people. And the venture arm is a wholly owned subsidiary. So we kind of operate independently. In terms of our approach to risk, we're generally cautiously optimistic. A big part for us, venture capital is a very risky endeavor. I think it's something like 90% of startups fail. For us, a big part of VC is, all you can do is really de-risk as much as possible the things that you can see. A big part of that is really getting our hands on the product or service ourselves. So, we're okay to lead or co-lead rounds. A big part of what we do is really getting our hands on the product or service. If it's hardware, we'll ask them to send it to us. That's not feasible. If it's too large, we'll fly and go see it on site, or we go to their office. The important thing is that we need to be able to see and watch what it's doing ourselves. If it's software, we'll ask for access. We'll play with it. We'll try to break it. We'll try to understand what it's doing. It's very important that we understand what it's doing, because if we don't understand, then we won't invest. It won't make any sense. The other thing that we're looking for is really, is it doing what's being advertised? Is it doing what they're saying it's doing? So we feel like, because we're looking at it ourselves and because we're checking all these low level things, we feel like that goes a pretty long way to de-risk the tech itself. The other part of de-risking, I would say, really comes down to the team, which is probably the most important thing you can look at. These are very these are long horizon investments. We're looking at 10, 20 years. And we want to spend time with the team to really understand what drives them. We want to spend time with them to build a rapport. We want to get an idea of what it is that they think about, and we want to understand how they react to feedback. A big indicator of success for startups is really being able to be nimble and make changes quickly. Their MVP, their product or service, it'll likely pivot, dozens of times possibly before they hit product market fit. So their ability to really absorb change and execute on it quickly is a very key indicator of success for us. So it's unlikely that we would invest in someone that we had just met. It's more likely that we would spend time getting to know them, and really build that rapport and build that trust. And we feel like, those two areas are big areas to look at in terms of just really de-risking the venture and building that trust and that really that confidence in the company.
Got it. Absolutely. Now, our portfolio companies come from pretty much every vertical that you can think of: fintech, deep tech, biotech. They mostly tend to be in early stage, as given KiwiTech's model of equity for services partnership. And so, one thing I'd love to learn from all three of you is that as you're looking at new companies today, someone looking to maybe start out their entrepreneurial journey, has a great idea, what would you advise them? What would you tell them that, okay, this is the climate, and let's maybe I can keep it as much sector agnostic as you can. Would love to kind of see, maybe a quick 1 minute roundtable. I know we are coming up on time. So again, we're starting with you, Myron, Suzanne, and then Karan. Kind of any advice you would have for somebody kind of starting out in this entrepreneurial journey. They have a great idea about maybe what they think is a great idea. What would you tell them?
Yeah, I mean, I think we get asked this a lot. I think the biggest thing to consider, or at least one of the biggest things to consider, is, do you need to build this right now? Timing is very important. Is there something that already exists that gets this done? If so, what is it about your offering that's going to be differentiated? What's remote? How are you looking at this? Investors will want to see a large market size, so that's something to consider. If it's super niche, that'll be something that should be factored into your raising strategy. And I think Suzanne touched on this earlier, but one of the biggest challenges I have is really, after seeing hundreds of pitches and startups, there's an element of storytelling that's really missing in a lot of cases, because at the end of the day, you're selling a vision, you're telling a story, and that's a very crucial element. So if you're not good at it, that's potentially a problem, at least in my view. The other thing to mention is really, you have to really understand the problem space. You have to understand the competitive space, and you have to be able to, more important than you understanding it, you have to be able to articulate it to someone else who's not necessarily in that vertical. So for instance, KiwiTech, you had mentioned you're generally agnostic in terms of sectors, verticals. A lot of times the company may be, they may be inclined to talk as if, you sort of know the industry, this area well, when in fact you don't. It's the onus is on them to really just dispense it down to something that's easily digestible, and quickly absorbable, especially if you're doing a quick pitch to someone, in a matter of a few minutes. So a few things to look at. Do you really need to make this solution right now? Is there something else that's already doing it? And if so, why is yours different or better? Why are you the one to do it? And are you able to really tell that story and take it to market? I think those are some of the things to consider.
Suzanne?
Yeah, I think those are all great points. I would just add to it, when I am talking to a company, I always enjoy it when they can give me a tutorial on the subject, because I feel that they've really done a deep dive. And then if they have to pivot, they have a better sense of how to pivot. And I would say, in addition to those points, I would add, it's always good to have a balanced team. We invested in one young, brilliant IT person, but he never brought on the business person. And so he completely burned out. And so you have to have that. And then don't be afraid to bring in advisors, because as much as you know, as a startup company, you can't know everything. So bring in advisors who can open doors for you, give you feedback, introduce you to prospective customers, have those conversations around product market fit, get some honest feedback. All those things will really help the company refine their vision and their process.
Got it.
Yeah, so look, I would say, not only from our perspective, but in general, venture investing, especially in this new environment, I think early stage companies have to go back to focus on fundamentals, right? Which means they have to have a path to making money, right? Having positive unit economics. And we understand that, look, at early stage, may take a while, but if you don't have a plan on how you're going to get there, it'll become increasingly difficult for you not only to raise money, but just to survive as a business, right? And we understand plans change and, you may have to pivot, but it's important to have a plan, right? I always say, plans are useless, but planning is very, very important, right? So if you have to do the planning, and then those plans may change, but you have to have done it.
Fantastic. The team actually reminded me we have a few more minutes. And so one thing I would like to ask all three of you, again, they'll stay in the same order, Karan, so maybe starting from you, is, and the good thing is that most of you are fairly sector agnostic yourselves, a little bit kind of stage dependent. Obviously, Suzanne, I think you're quite early stage with the angel group that you're looking at. And then Karan, I imagine you might be a little bit later stage. But tell me a little bit more about industries, as you look forward over the next quarter, over the next year. What are some of the industries that you're really excited about? Maybe give me the top three that you're looking at, excited about, see a lot of feel actually really motivated to invest because you think maybe they're undervalued industries or sectors, or even if they're not undervalued, they're just kind of a lot going on and you would love to get in on the action. So Karan, top three industries.
Look, for us, the biggest, even today, and it has been for a number of years, has been, the fintech space, and specifically within that, the lending space. And especially in this current interest rate environment and what's happened with, some of the regional banks and SVB and so on. There's a big gap in the market in providing lending capital to consumers and businesses, which are off the ordinary, right? So what we call alternate lending. And there is going to be, good technology-backed, analytics-backed fintechs that are going to fill that gap. And in other, this is specific to the US, but in emerging markets like Asia and India, there's always been this big gap where banks do not lend enough, right? And so there's a huge opportunity for alternate lenders to fill that gap. So we've always been very excited about that, and specifically here in the US in the current interest rate and banking environment, we're very excited about this industry going forward.
And I'm really glad you mentioned that, because literally just before the call, I was reading this fantastic article. Again, I'm going to put the link in the chat window about startups looking at international venture capital companies and looking at cross-border opportunities. I mean, obviously very close to Suzanne, what you are doing between Chicago and Poland. But yeah, coming to you, Suzanne, top three industries.
Okay, well, I would say no matter how much governments try to cut healthcare spending, it seems to always go up. So we are bullish on healthcare. And then I would say a second one would be the whole area of climate change and environmental innovation. It used to be that those companies took many years and many millions of dollars to get off the ground. But now that rules and regulations are coming out and governments are requiring companies to change, we see more opportunity there. And also, I think the entrepreneurs are becoming more creative about how to get companies up and running with a lot less capital and in a shorter amount of time. And then I'd say the third area is industrial and agricultural work. Industry is really looking at least in the United States and in Europe, they're looking for ways to be more innovative and more cost effective. So we see opportunity there. Same with agriculture.
So I wrote down healthcare, climate, and agriculture. And being from Chicago, if you hadn't said the last one, I would be worried. So I'm glad you did finish on that note, industrial/agriculture. And then where you're in you?
I'll echo Karen's sentiments on fintech. We're still very excited about fintech. I think that startups are slowly decoupling a lot of these massive services that these bundled services that these banks have, these large monoliths. They've been slowly doing that over time, and I think there's still a lot of work left there. It was probably like 12 years ago, you had to call your broker to place a trade. fast forward to now, fast forward to a couple of years ago, 2-3 clicks and you're buying stock. And we're going to see a lot more of that. We're seeing a lot of that in areas like payments, mortgages and lending. But I still think it's a super exciting area, and I think there's a lot left there. So we're super excited about that. I also like manufacturing. I think that there's a lot of interesting things happening there, specifically around hardware-enabled manufacturing. So a lot of predictive maintenance, failure detection with sensors. We're seeing a lot of that being deployed. I think there's a little bit of a hill there because it's not clear. The value prop may not be clear to the client why they need it, and the onus falls on the startup to really say, this is why you need it. This, it's going to save you time and money and labor. But I think once it sticks, it'll really stick, because the value prop is definitely there. What I'm most excited about is probably agriculture. I think that this is a recognition that by 2050 the population will have hit an all-time high. It's a very high number. The current means of producing the food from farm to table are not going to be sufficient. So all kinds of companies are being formed, and they have been being formed over the last couple of years, around they're using everything from biotech to chemicals to figure out how do they grow more efficiently, more cleanly. For us, we're more interested in precision agriculture because we feel like that's where we can really understand and add value. So we look at things such as sensors that are on the field, insights on crops, and on the plants, plant level insights rather, from things like drones and satellites. And we look at robots. There's a huge issue with labor shortages on farms. And that's where robot pickers are really handy, whether it's picking plants or vegetables or simply removing weeds. So we think that that's a very exciting area for us to be focused on.
Got it. And you're in all fantastic points. Though on the point of the population growth, the New York Times would like to disagree with you. Again, I'm going to put a link in the chat window from a front page news in the New York Times 2 days ago. Because as soon as you said that, I'm like, oh, interesting, because I just literally read that 2 days ago, where they think it's about to peak and it's going to be going down and down from here. The whole thing around, again, a lot of countries where, folks are not having kids, and then, kind of as those countries become more affluent, obviously we're seeing China. But anyway, it's interesting, again, kind of neither here nor there. But again, as you mentioned it, so I thought I'd put that. It's a paywall though, but again, if you have subscriptions, feel free to check it out.
It's hard for me to comment because I haven't seen it yet. The data I'm going off is what was published by the UN, so I kind of took it as face value.
No, you're right. That's what I've seen myself, and then that's why it's a very contrarian kind of a piece, and maybe provocative piece even at the New York Times. So anyway, I thought I'd share that. So good. So we are a little past time, but we do have opportunities for QA, and I do see a question coming in from Michelle. All right, so let me read the question, and then Suzanne will go to you because it does seem to be very healthcare related. And so Michelle is asking, from a VC and angel investment perspective, is there more interest in true health prevention? But definitely health prevention. True health, I think maybe promotion and weight loss medication, given the rise in obesity, metabolic disease, given the fact that weight loss medications are becoming more mainstream?
Yes, so I think generally speaking, in all these healthcare questions, you have to ask who's going to pay for it. So if it's something that an insurance company will pay for or the government will pay for, it's certainly a much smoother path to market. If you're talking about real preventative medicine that might include supplements or yoga or alternative care, then you've got a much more difficult and challenging path. Certainly within healthcare, diagnostics are very popular right now. Outpatient services, anything that could save money for a hospital or or add revenue to a doctor's practice, those are all hot areas. So when it comes to specific things like weight loss drugs, I guess I would just go back to if you can get somebody to pay for it, that's great. if the consumer's paying for it, now you've got a challenge.
Got it. Either Karan or Mayuran, we have a few more questions now coming in. You want to take a crack at that, or again, left to move on to some other questions? No. All right. One question that
nothing
came
to add there. Yeah.
No worries. One question that came for all three panelists in a direct message is, tell us a little bit more about the last investment you made. You know, kind of how are times changing? You know, how would you have maybe looked at deal differently 6 months ago, a year ago? You know, tell us a little bit more about that. Just your last investment and kind of, you know, I mean, you don't have to share names. You're welcome to if you want to, but otherwise, you know, tell us more about, yeah, kind of, you know, and in order, let's go in the reverse order of where we started. So maybe let's start with you, Karan, and then to Suzanne, and then, sorry, Mayuran. So with Mayuran, Suzanne, and then Karan.
I think the biggest thing we would have looked at differently was probably the valuation. You know, it was a little bit before the markets had contracted, and before the effects have been felt on the VC landscape and the VC industry. So we would have looked at that differently. Now, luckily for us, like we typically look at the fundamentals. It's, you know, we're not a big fan of grow at all cost. We're a big fan of grow efficiently, but not at all cost. So I think that, you know, while we may have looked at it slightly differently, I don't know if it would have changed terribly. You know, it wouldn't have been a huge drastic change just because we always look at fundamentals. So I think in that sense, it might have been in the same realm. But yeah, I think that's what we would have looked at it. Everything else would have largely been the same because we try to keep it pretty static.
Got it. Suzanne, last investment you made, and then in the meantime, Karan, Mayuran, we have a question from Kevin on the chat window. If you maybe want to type out your answer or address that, you know. But Suzanne, in the meantime, you know, share some thoughts on the last investment you made. You know, again, sector that was in, anything that was different than what you had done previously.
Sure. So our last investment as a group, I invest individually myself, but the last investment we made as a group was in a company that helps corporations better manage their mentoring program. And we thought this was really cutting edge, and perhaps it still is. We'll wait and see. But it's interesting because after investing, we had two more companies come to us that were helping corporations better manage their mentoring programs. And now I wish that maybe we should have waited a few months to get a better sense of that. Obviously, workplace issues are coming up now with new innovations and startups. So I think we're going to see a lot in this space. And maybe we should have just been a little more cautious, but we'll see. I mean, this company has great traction, so hopefully it'll work out.
So tell me a little bit more about that mentoring, as in like soft skills, like executive presence, on maybe DEI stuff, or kind of, you know, what kind of mentoring?
Yeah, so this company developed a mentoring program that was something that the corporations could just include as a turnkey operation. And they would put people through this mentoring program, and they could monitor the results. And so far, they seem to be producing a good return on investment for the companies. So it's well worth the company's time because they don't have to set it up themselves, right? It just goes in. And then the other company that came by just recently would pair up the employee with another employee based on their mentoring needs. And then the third company would actually just be agnostic on all these mentoring programs, but just help the company manage all the mentoring programs the company has and make sure that they're producing a return on investment. So very different approaches to the same problem.
Got it.
Did I?
No, it did. Thank you.
Sure.
Suzanne, you did answer it. So thank you so much, Karan. While we go to you and then Suzanne, again, Marian, questions coming both on the chat window as well as the QA window. Question from Taras around ESG investing, and then from Chris around our safe notes or convertible notes, more kind of preferred. again, one being a corporate venture capital, another one being angel investment. Feel free to kind of type out your responses, and then Karan will finish with you. Last investment.
Yeah, so look, from our perspective, in the current cycle of investments versus, what we may have done 12 or 24 months ago, I think there have been two key changes. One is, obviously pricing. And for us, pricing is directly tied to the interest rate environment, right? Because, as interest rates go up, our cost of capital goes up, and we're forced to pass that on to our borrowers. So what changes with that is we then have to assess cash flows more critically to be certain that, a venture can actually afford to take capital from us and be able to pay us back. Because if not, then, not only hurting us, but we're actually hurting the venture itself, right? And the second is we now are much more conservative and critical on runway, right? So we now, look at burn very closely and are very conservative in estimating, when they need to raise capital and how much they need to raise, and assuming that it'll take them a lot longer to be able to raise that. So, we make sure that we will give ourselves enough window before the company sort of has to raise capital and starts running out of money. So those are two things we've, that have changed the most in the last year or so, I would say.
Wonderful, wonderful. With that, we're coming up on time. Again, a lot of really good questions coming. Michael was just asking about current interest rate environments. Suzanne, thank you so much for answering that. And again, as folks, please feel free to put your questions in the chat window. But with that, we'll start the pitches now. Again, Karan, Mayura, and Suzanne, thank you so much for your time today. Really appreciate it. Please do stick around for some fantastic investment pitches that we have coming up. I know we have companies from pretty much around the country and actually around the world pitching today, from the San Francisco Bay Area to Miami to Dubai. Again, from different sectors. I think we have ag tech, going back to what was being shared a little bit earlier, agriculture technology to media play to fintech, again, completely agnostic. So again, good luck to all the folks presenting today, and Nosheen and Shubham, back to you.
Wonderful. Thank you so much, Ike. Hello, everyone. Thank you, Ike, and all our panelists. On behalf of everyone who has joined us today, we sincerely appreciate all of your wonderful insights and perspectives shared by our panelists. And I would kindly request you all to stay back and provide some feedback to our startup founders as well who are presenting today. Okay, guys. So thank you for sticking, all of you. Now we'd like to move on to the next exciting part of the event, which are the presentations from our high-value growth stage startups. Before I announce the startups, let's quickly go over the house rules. Each presenter will get 6 minutes to pitch, followed by a 2-minute of Q&A with the jury. After each feedback session, we'll conduct a poll for you to rank the presentation and seek investor introductions with the startup. There will be a feedback form link provided in the chat feature for attendees to fill out. It helps us maintain and improve the quality of our events, so please don't forget to fill the link. Also, with the house rule clarified, I'm super excited to introduce 5 of our esteemed startup founders in order of their presentations. They are Antoine Cannon, CEO and founder, Huck; Upaji Kochapalli, founder, Gromi; Kelly Greaves, CEO, Wine Technology Incorporated, doing business as WinWizard; Dr. Ravi Singh, founder, Social PayMe Technologies; and our last would be Tara Scrapchuk, CEO and founder, Tarform. First up, I would like to invite Antoine Cannon, CEO and founder of Huck.
Hello,
Hi,
thank you
hi,
for the
Antoine.
invitation.
How are you?
Hi, how are you?
I'm doing good.
Thank you, everyone. I'm
Okay,
very
Antoine, the
happy to
screen.
be here. It's my honor.
Sorry, you're not audible. Saying something?
I said it's my honor to be here. Thank you very much.
It's our pleasure. It's our pleasure. The screen is all yours, and with house rules clarified, you have 6 minutes. All the best.
Thank you very much. So, guys, let me introduce myself. I'm from the Middle East. My name is Antoine, and my startup is called Justice in Arabic. We call it Haq. And we're all about digitizing the way lawyers work.